What's up, YouTube? It's E of E&L Finance coming at you with episode 3 of the M1 Finance Challenge, where our goal is to build a portfolio that's able to compound and reinvest its dividends. In this week's episode, we'll be looking at how much money we need to invest on a weekly schedule in order to build this portfolio to reach our goals. But before we begin, if you're into stocks, investing challenges, and a different perspective of investing, hit the subscribe button and join the Bear Bull of YouTube. So the first portfolio we'll be looking at is our Aristocrats portfolio, where we picked 11 companies that we thought best represented long-term dividend payments for their individual sector. For this pie, we have AT&T, J&J, Federal Realty Investment Trust, 3M, Procter & Gamble, and then we have PPG, which is PPG Industries. We have IBM, Con Edison, Aflac, McDonald's, and Chevron. These companies not only have long histories of consecutive dividend payments, but these companies also have a long history of representing or dominating their individual sector. Now, because the market is always fluctuating, we're calculating the general amount it will cost to acquire one share of each company in this portfolio. It will cost us $1,378.49 to acquire one share of each of these companies, which will give us a yearly dividend of $42.92 or a quarterly payment of $10.73. Now, moving on to the balance pie, we have Target, Domino's, Microsoft, Honeywell, Duke Energy, Waste Management, Abbott Laboratories, O Realty Income, Stanley Black & Decker, JP Morgan, and Verizon. I know what you might be saying right now. These companies are very large in market cap, but we feel like there's still plenty of room for these companies to grow, and grow in a sense in which they either acquire smaller companies to then grow themselves or continue to grow in market cap value. With that said, it will cost us $1,912.53 to acquire one share of each of these companies, which will give us a yearly payment of $32 or $8 quarterly. I know that's not a lot of money, and we're actually investing more money than the previous pie. We feel that these companies position themselves to grow and continue to grow their dividends. So right now they might not be paying a high dividend, but over the years they will consistently increase their dividend payment. This is what the balanced portfolio is all about. It's about acquiring companies that are going to grow in company size and in dividends. Now, moving on to our last pie, the maximum gain pie, where we chose companies that not only pay a very high dividend, but position themselves to afford this high dividend with their company's business and product. First up is Apple. Yes, right now it only pays 20 cents, but give them time. They're going to reach their 80 cents dividend payment in no time. Then there's Pepsi, Home Depot, Allstate, American Electric, Crown Castle, Caterpillar, Cracker Barrel, Public Storage, AbbVie, and of course, ExxonMobil. Can't have a high dividend paying portfolio without ExxonMobil. This pie will cost us $1,800.16 for a total yearly payment of $49.08 or a quarterly payment of $12.27. Altogether, to acquire one share of each company from every pie, it will cost us $5,091.08. If we were to break that down weekly, we would need to invest $97.90, which is crazy because when we sat down and thought about doing this challenge, we said, well, to grow a portfolio like this, we would need to invest $100 a week. So it turns out, after doing the math and the calculations, we are close to what we initially said we would need for this challenge. Once we do have one share of each company, we would be getting $124 in dividends from the entire portfolio. Just imagine, once we have 10 shares, that's $1,240 a year. Granted, that means we would have to invest close to $51K in order to accomplish this goal. But when you count reinvesting and constantly investing every week, this goal can be accomplished quite quickly. Remember, the goal for this challenge is to build a portfolio that's able to reinvest in itself, not only itself, but with our other pie, the growth stock portfolio, We want our dividends to just continue to grow everything, the dividends and the growth stocks, so that when we're ready to retire, we could just catch out. Let me know in the comments below if you guys think I should create another pie with just ETFs. Thanks for watching. I hope this video was helpful in some way, and if you don't mind hitting that like button, it'll be greatly appreciated. And if you enjoyed today's information, don't forget to hit that subscribe button and join the team. See you guys in the next one, and remember to follow the 3 M's. Money makes money.